There was a moment when the price of risk quietly broke. No sirens, no headlines, just a calm where fear used to live. You can feel it now. Money is cheap in places it shouldn't be. Borrowing costs barely flinch at danger. Speculation trades with the confidence of blue-chip stocks. And when markets wobble, they steady themselves faster than they should. This isn't courage, it's conditioning. Here's how risk is supposed to work. Danger costs more. If a borrower looks shaky, lenders charge higher rates. If a business is fragile, investors demand more upside to touch it. Fear leaves fingerprints on price. That's the signal. That's the break. For most of modern market history, that break mattered. In the 1970s, inflation burned. In the 1980s, rates bit back. In the early 2000s, bubbles popped and stayed popped. If you mispriced risk, you paid for it, publicly and painfully. Then something changed. After each crisis, the response got faster and softer. Central banks cut rates, liquidity arrived on schedule, losses were smoothed, markets were steadied. The lesson wasn't written into any rule book, but it was learned. When things break, someone shows up. So prices began to reflect the rescue, not the risk. Volatility fell. Credit spreads narrowed. Leverage crept higher, not because danger disappeared, but because the penalty for being wrong felt smaller. This is the uncomfortable math hiding in plain sight. If downside is softened, upside becomes addictive. Returns look stable. Strategies scale up. The same trades get crowded. Risk doesn't go away. It concentrates. Publicly, this is called stability. We point to smooth charts, steady growth, fast recoveries. It looks like maturity. It sounds like control. Privately, the system is pricing something else, not the reality of loss, the promise of intervention. That's why small shocks fade fast, and why the space between shocks fills with quiet risk, pressure without release, confidence without memory. The long-term danger isn't one bad trade. It's a market that forgets how to flinch. When fear is dulled, warning signals go quiet. When warning signals go quiet, mistakes grow larger before anyone notices. So the next correction won't feel like a correction. It won't announce itself. It won't knock politely. It will arrive as a surprise. And here's the uneasy thought to sit with. If prices no longer reflect danger, what exactly will tell us when the danger is finally real?